I'm Julia Cordova, and welcome to the Place Your Trades Network. We are the network that focuses on trading daily options using CME Group event contracts to trade E-mini S&P, NASDAQ, Dow, Russell 2000, gold, silver, euro, crude oil, natural gas, and copper. We have a great show for you. I have Heinrich Leopold on to talk about basically how M2 affects the cycles and how we can anticipate volatility and liquidity ahead of time. Today's broadcast is brought to you by Tradeovate, which has built a custom app dedicated to trading the CME Group event contracts. That's what we're all using at Place Your Trades. And the PYT team is going to be live in Las Vegas at the Money Show on April 24th to 26th. So I hope to see you there. Okay, so I thought I would crazy market action that we have seen just really since Sunday's open. Last night, we just went up incredibly. It was just like trading during the regular US hours. There was a lot of movement. We went way up and then way back down. But right now, it looks like it's trying to recover. My best guess for today, and I could of course always be wrong, is that we'll close close to where we ended on Friday. I think ahead of the CPI, I think potentially we'll sort of balance out a little bit, and then we'll see what happens tomorrow. But right now, I could be wrong about that because it does seem to be going up. As far as oil goes, I have been bearish oil for quite some time. I did take last night's small 1% up move to go short, and then I closed 2/3 of that at 72.5. I'm thinking about adding it back right now because we are right now at the bottom of the pennant that I think that we already broke down from. But 72.5 is critical support for oil. That's where below 72.5, I think it's going to go into the mid 60s. So maybe they save it. I don't know. And then gold and silver are super strong right now. I do have, though, resistance for gold here at 1913.3. So yeah, I think potentially gold might come back down to earth for today from about these levels. So that's my opinion. But with that said, let's bring in Heinrich. Hello, Heinrich. How are you?
Yeah, I'm fine. Thank you very much. Greetings from London.
I appreciate you making time for me. You're just one of my favorite follows because you have such an interesting perspective and you're so methodical. You know, when I read that you were a chemical engineer, I thought, oh, that's exactly what I would think because I'm a mechanical engineer by training. But when I read that you were a chemical engineer, I'm like, that makes sense because you are so logical and you go through your thought process in such a wonderful way that I'm just incredibly excited to learn from you. So thank you.
Yeah, welcome.
So let's go ahead and show, you sent me some slides. Let's go ahead and show them. So today we're going to talk about economic cycles and monetary M2 growth. Maybe you can start off by just saying a little bit about, you know, why you chose this particular avenue to follow and, you know, what basically why you use this kind of logic.
Yeah, as a retail investor and scientist, I have been asking myself always when to buy, when to sell, and when to hold. Yeah, this has been always the question. And I went through horrible down cycles, yeah, but also up cycles. But actually, I was never knowing what I'm doing. Yeah, so it was just going through fog. Yeah, at high speed. Yeah. So, so I tried to find an indicator which actually guides me through what will happen in the next 6 to 12 months, and this is the real monetary growth. Yeah. So, and I think it gives us a hint where the market will be going in the next 6 to 12 months, and I feel very comfortable now to hold, to sell, or to buy.
Awesome. Okay. So should we start off? So we start.
Yeah.
Okay.
Mm-hmm.
Let's see. All right. So the
Ah,
first
yeah,
you sent me was M2 and economic activity or industrial production.
exactly. Yeah, from this chart you can see we had cycles. Yeah, around five, 1 year plus minus. Yeah, so over the last 20 years we had four cycles, and the fifth cycle is just completing now. So in 2001 we had the first down cycle, and in 2009 there was the second. Around 2015 there was the third, and the COVID bottom was actually in 2020. Now, how can we actually foresee this? Yeah, so it was very surprising for everybody, I think, and so we can foresee this with the monetary growth. Yeah, when the monetary growth goes close to zero or is very low, then the danger for deflationary shock is very high, because the philosophy behind this is an economy and also the stock markets, they need money on the table. Yeah, if monetary growth is high, you have enough money on the table which you can actually distribute, yeah, to the stock market, to shareholders, to businesses, to companies. So when economic monetary growth is high, there's a high chance economic activity is also high, and vice versa. When the monetary growth is going down, there's a high chance that we will get very weak economic activity. And you can see this here from the cycles. Now, when uh, monetary growth is going down, we have around 6 to 12 months the bottom of the cycle. But the good thing is also that monetary growth actually accelerates during a down cycle. So we get a recovery very quickly. Yeah, we have seen this in the 2002 bottom. Yeah, we have seen strong monetary growth. You can see this from the blue line. And also in 2008, 2009, we had strong monetary growth, and then we had a swift recovery. Yeah, and the same in 2015, and the same also in the COVID cycle. Yeah, so the COVID cycle was a brutal cycle because the downturn was short but very brutal, and of course the monetary growth was then actually very, very high. And now what we have seen in the last year is that now the monetary growth was down very considerably, actually to all-time lows. Yeah, this is very interesting now because this tells us something about the future, and I will come to this later. Yeah, first I want to explain what actually influences the monetary growth, and that's in the next chart.
Okay, let me go there. Okay.
Yeah, here you see this. This is the correlation or inverse correlation between inflation and monetary growth. When inflation is high, monetary growth is low, and then we get actually a big danger that the cycle is falling through. It was the case in 2002, the dot-com crash, and then in 2008, 2009, yeah, we had also very low monetary growth because of inflation. Yeah, and also we had in the current cycle, yeah, we had high inflation, and this made the monetary growth to slump, and this is why the Fed is actually so keen to bring down inflation, because actually it's not about inflation, it's about monetary growth. They want to get up monetary growth as soon as possible because they know when the monetary growth is low or even declining, then we get a very, very weak economy ahead the next 6 months. So there's, so to speak, no money on the table which can be distributed. And this is actually the point now about these bank problems and what we have now is actually the point that there's not enough money going around. Yeah, so treasury have declined. So banks have a declining collateral. Yeah, which is a problem for many banks. Yeah, because their balance sheets are actually in huge imbalance. Yeah, so and also stuff like this. So the markets would need high monetary growth, and this will only come when the inflation goes down. This is why the Fed is now so eager to bring down inflation, because they know they need monetary growth. And actually, there you can also see the mistake of the Fed. The Fed has actually waited too long, uh, and then inflation got out of control, and now monetary growth is out of control, yeah, in decline. And now the Fed has to correct this. Yeah, so we can see now how this affects the markets. Yeah, the monetary growth, and it's in the next chart. Yeah, here. Yeah, exactly. Here is actually the copper. Yeah, copper is swinging wildly. Yeah, with
It
the
is.
with the
Copper has been
cycles.
copper has been super volatile.
Yeah,
Just yeah, and I
yeah,
can't
yeah,
quite. And I gotta be. I'm not a macro person, but I was trying to reason it out to myself. It's like you want copper to be more expensive because you want the economy to whatever, but
yeah, yeah,
inflationary part of it.
yeah.
So it's like,
Mhm.
I was actually a little confused. I mean, I just look at lines on charts, but that is confusing to me. So what is this saying to us here?
Yeah, you see here, because copper swings so widely, 100 whatever, 150% in one cycle, and then
Mhm.
it's going down again. Now you can see only the monetary growth and industrial production is actually is very small here. The changes, yeah, because the schedule is the axis is cannot be changed here. So you see when we have a falling copper price, monetary growth is growing, yeah,
Oh
and
yeah.
this lays the foundation for new copper rise, yeah. So we have seen this in 2000, in 2008, 9. We have this seen in 2015, and also in 2020, yeah. So it was an excellent point in 2020, and this was my first success, yeah, because I then invested in silver calls, yeah, in March 2020, and sold them in August, yeah, for a profit of over 1,000%, yeah. So this is exactly when I for first time could use this chart, yeah. So what we see on these charts, you should go into copper and silver and gold and also metals
Right now.
when the market has reached bottom, yeah.
Okay.
So and then run it until to the top, and the monetary growth actually is telling you, yeah, that the top is coming, yeah. So in 2020 we have seen this here exactly, yeah, that monetary growth was leading the copper price to the upside, but
Okay.
it's also leading to the downside, yeah. So I think it's very dangerous to go into copper now,
Okay.
because the monetary growth is still declining. I mean, there may some bear market rallies or whatever, but I think over the next half year, it's not good to go into copper now. Yeah, maybe gold. Yeah, because it's a monetary metal.
It's
It's
not an
not a
industrial.
industrial.
Yeah.
Yeah,
Yeah.
because copper goes with industrial growth. Yeah, so we will get in the next 6 months we will get weak industrial growth. Yeah, so this is the first chart has shown this already. Yeah, I'm pretty sure that this will happen. We will. So we have discussed a lot about inflation and too high inflation, but now in the next year we will discuss about deflation. Yeah, so we are on the other side of the hill. Yeah, now we had to climb up, and now we are going down the hill. And of course, there will be rallies, counter rallies, and so. But the trend is only up when the monetary growth will go up again. So for copper,
Okay.
it's too early. Yeah, it's too early. You
So
have to wait until the monetary growth is coming up, and that's actually what we have seen now, because the monetary growth is going up, when interest rates are going down, yeah,
Okay.
treasury rates, yeah,
Mhm.
because this means demand for treasuries, and this
So,
this will liquidify, yeah, the cycle, and we will get maybe 2024 very high copper price again, yeah. So, but not now, yeah, in my view, yeah, in my cycles, yeah,
okay, got you. No, that's,
yeah.
that's very
So,
interesting. That is super interesting.
yeah.
Now there was talk of potentially a Fed pivot coming a little bit sooner than most people had expected because of the bank
Mhm.
failures. So could this viewpoint change for you? And if so, when would you decide that it had
Yeah.
changed?
Yeah, you see here, there's a time lag of 6 to 12 months. Yeah. So when monetary growth is coming back above zero, yeah, or rising strongly, it can only be done by lowering interest rates, yeah, and monetary measures. Um, then it is a waiting time for 6 to 12 months. So until the copper price can rise. So even if interest rates would go down tomorrow, yeah, which we have seen in the COVID cycle, yeah, the COVID
Right.
cycle was so. The Fed reacted immediately, yeah. So they immediately brought the interest rates back to zero. But still, there was a time lag of 6 months until copper could rise. You can see it here. The blue line is earlier than the green line. Yeah,
Oh yeah,
this
I
is
see
very
that.
important.
Yeah.
So we need uh, uh, we need money on the table. Yeah, that means monetary growth, and then we can get more growth on metals, on all other economic activities. Yeah, so
Okay.
this is very important, and this is my guide. Yeah, and I know it's tempting. Yeah, to jump in. Many people send me tweets. Yeah, and say, "Ah, silver is going up, gold is going up, copper is going up." So we should go in aggressively, but I don't think so. There's a better time coming. Yeah, of course you can
Okay.
make short-term trades. Yeah, 1 month or so. Yeah, but this is not telling you about short-term trends. It's telling you about long-term trends, and only when the blue line is decisively in an upward move, then you can go aggressively. Yeah, for copper.
Okay. No, I'm so
Mhm.
happy that I'm so happy that you agreed to talk to me, because I have to say I've seen these charts that you tweet. I've read your words, but as you explain it, I feel like I'm understanding your viewpoint so much better. So this is
Uh-huh.
awesome. I love this. So
Yeah.
let's talk about energy then.
Yeah, and the same is the energy. You see, when energy is going down, it's the leading factor is actually monetary growth again. So we have seen this in the 2002 cycle, when monetary growth was close to zero. Yeah, the energy prices fell, and then monetary growth came up again in this kind of recession. Yeah, so the whole cycle could reload with money, and was ready to jump again after 2003. I remember the oil went up again. Yeah, so high oil prices actually meant high inflation. So monetary growth was low. So it did it around, around the edge for 4 or 5 years. Yeah, and then actually fell through in 2008 and 2009. And then you see, then we had monetary growth again, and then in 2010, 2011, we had high oil prices again. So the period between 2012 and 2018 has been rather calm. Yeah, there was stable monetary growth. So energy prices, yes, they fell in the 2015 cycle, but actually didn't move before that much. Yeah, but then in 2018, yeah, energy went up once again. Yeah, you can see, and you can see here also very good when energy prices came up, monetary growth declined again. So paving the way for the next down move. Yeah. So, and this was the COVID, and the COVID down move was actually bad luck, because actually the cycle was already recovering. You see this from the blue line, which is
Yeah.
going up, was going up already, and the oil prices still went down, but this indicated already that oil prices will go up strongly. Yeah, the strong increase in the blue line predicted actually a high oil price. Yeah, and now, so you can see, because the blue line came down significantly, it's predicting a low oil price for the next 6 months. Yeah,
Yeah,
maybe we get some. Yeah,
yeah.
we get some kind of counter rallies. Yeah, but the trend is actually weak for the next 6 months. Yeah, I'm pretty sure.
Okay.
So because these charts have shown many times, yeah, that he can do this. Yeah, the monetary growth is very, very important for future industrial growth, and it will not come when the monetary growth does not happen, and when the money is not on the table. It cannot be distributed, yeah, to consumers. Yeah,
Okay.
yeah, we
So,
can.
sorry.
Yeah, yeah.
This.
This we can see this also from for the next chart. There's also the Nasdaq there. Yeah, also tech. This is true
Okay,
also
but
for tech. Yeah,
real quick on
yeah.
energy, I want to say, you are a contrarian. I know I am too sometimes. I'm not a contrarian to be a contrarian, but when I see a chart that doesn't look bullish, I will just say it does not look bullish. But there are there are a lot of oil bulls out there.
I know.
I
Uh,
can't count them. So, you know, and I always keep, of course it could be wrong, but yeah, this is really interesting stuff
yeah,
ahead
yeah,
of that. Okay,
yeah.
so
Let me explain this point in energy. It's I think long term, I'm bullish for energy as well. Yeah, so
me too. Me too.
I recognize the supply situation, whatever, but from the monetary perspective, which is actually demand. Yeah, monetary is demand. Yeah, so monetary uh, can actually control demand. It cannot control supply. Yeah, the Fed cannot print oil. Bernanke said 10 years ago. So, but of course they can print money. Yeah, this is what they can, and so they can influence the monetary cycle. So, but in this case, because we don't have monetary growth, the situation for oil is quite weak. The demand situation is very, very weak. Yeah,
Okay.
and I mean the proof of this, yeah, has been actually these troubles with the banks now, yeah, because it's the same for the banks as well, yeah, because when there's not enough money on the table, also the banks have difficulties. We can
Okay.
see this also for the Nasdaq. This is the next chart, yeah. Yeah, you see here. Yeah, also is here when monetary growth is close to zero, then we got the dot-com crash in 2002. And then in 2008, we had also a crash because monetary growth was not very high. But during the cycle, during the recession, there has been huge monetary growth, and so the cycle, the stock market could go up, and for the best period for the Nasdaq was actually between 2012 and 2018, yeah, and of course the COVID cycle. But you see also in 2018, monetary growth came down, and this is also what actually weakened a little bit the Nasdaq. But then when the COVID cycle came and huge monetary growth came, Nasdaq also soared. Yeah, but it's now because the monetary growth is going down now. I'm not very optimistic for the Nasdaq too, despite the rally we had. Yeah, and despite all people are, because it's just a monetary thing, and it has nothing to do with the fundamentals of a company and the fundamentals of our quality of innovation and quality of a company. It's simply the monetary cycle, and when the money is not there, it cannot be distributed to shareholders or to whatever, to banks and whatever. And we will get more troubles, I'm pretty sure. Yeah,
Okay.
but
So
the good thing is this: because we get troubles, the monetary growth will accelerate once again. Yeah, so each crisis has actually a good thing. Yeah, and it's actually necessary. Yeah, to pump up the monetary growth, and then when the money is on the table again, then people can spend, and then shareholders and whatever profit. But not now. It's very dangerous now in the next 6 months. Yeah, so I wouldn't do some long-term investments now. Yeah, trading, yes, but not long-term investments. I would wait. If you're a long-term investor, it's for long-term investor. It's also important that he goes in when the cycle is at the lowest. Yeah, this is where you can make the most money. I mean, cost averaging, you see these curves, yeah? You have a huge losses, but also a huge gain. But cost averaging, it's not a good strategy. But when you here wait patiently uh, until the cycle bottoms out, and you go then in, then you can make really good profits. And then it also makes sense to work with calls and puts, yeah, because calls and puts can only work when there are big moves, yeah. So and the big move in Nasdaq is not coming in the next 6 months. I think it's rather a big down move, yeah. So, but only monetary growth will give you the green light that we will see acceleration in the Nasdaq.
Now,
I mean, this blue line is a perfect indicator for this.
okay. So
Mhm.
what I'm hearing you say is that if there is a rally that's, I think it's possible we could get an extraordinary short covering rally at some point. And
Yeah, maybe.
what I'm hearing you say is that is something that, unless this blue line is back positive for
Yeah,
that,
exactly.
then it's
Yeah,
something that we should sell. And
yeah,
and when so if they do pause interest rates and don't start the monetary growth, that's what you're saying is that we would sell that rally at that time, and then
yeah. Yeah.
if they pivot from there to add when, I mean, I guess how often are these charts put out? Like, how do you manage that? Like, how is this a monthly thing
Yeah,
that we see this, or
yeah, okay. Now M2 growth was weekly, but they switched to monthly. Yeah,
okay?
but of course the Nasdaq I can get every day actually on a daily basis,
Oh, okay,
and
good.
industrial growth. Yeah, industrial growth I get on a monthly basis too. So I think tomorrow or on Wednesday, industrial growth is coming out, and I think they will go down steeply, and this will confirm my curve. Yeah, so it's very interesting. Yeah, I'm curious myself how these numbers confirm themselves. Yeah, so this has nothing to do with short covering rallies. It may be happen. Yeah, but I'm pretty sure in the next 6 months. It's very shaky. It's very shaky that it will go up, yeah, maybe, but then we get huge corrections, and you can only go aggressively in, yeah, with calls and with whatever you have, bet the farm when the cycle has bottomed. Yeah, so and this will take a while because the declining monetary growth indicates that the bottom will quite deep. Yeah, so this is a warning sign. Yeah, what we have here. So,
Okay.
of course, many people don't believe me, but I think it's true. Yeah. So
Yeah.
it's because it never fell, actually. The real monetary growth never fell, actually, in history. Yeah. The real monetary growth, and now it fell, and this is a very very strong signal. Yeah, so we have to be very careful. Yeah, fine, trading is fine, it's okay, can happen, but we'll see. Yeah, and then the next chart is also very interesting. Yeah,
Okay. Hold
about
on.
yeah.
I can't even see
Mhm.
my keyboard anymore. It's so it's stormy. I'm on the East Coast. It's only 11:30. But it's stormy here, and the dogs
Yeah,
are under my feet,
yeah,
so I can't move to turn the light
yeah,
on. But okay.
yeah. You see, this is very interesting chart because you can see here there is um, money growth, blue line again, yeah, but and then is market liquidity, yeah, of the banks, yeah, net tightening of credits. So you can see also that in 2002, yeah, we had low monetary growth. This triggered actually liquidity crisis, yeah, the dot-com crash, and but also monetary growth, yeah. So this brought down the tight liquidity, and the cycle could re-liquidate, yeah, and and the green line fell again, yeah. So the same situation in 2008, 2009, yeah. It was first the recession, and the recession brought us this re-liquefying of the cycle, the monetary growth came up, and then the economy could recover. Yeah, so it was actually so you can see from this there's actually a economic crisis actually needed. Yeah, without economic crisis, we would not get this monetary growth, which actually fuels the next recovery, the next cycle. Yeah, so between 2012 and 2018, again there was a calmer period. Yeah, there was only a short tightening. But then, of course, COVID, yeah, came again, and then we have seen this huge upturn in monetary growth, which actually then brought the tight liquidity quickly down. Yeah, so the Fed reacted very quickly. So this was formidable. Yeah? So, but
maybe I'm reading this one wrong, but doesn't it look like the green is leading the blue in this case? I mean,
yeah, this is exactly what I want to say. Yeah,
yeah. Sorry, I was
yeah,
like
because
not following
yeah,
there.
yeah, because the point is not this is not the copper price. This is actually the tight liquidity. So the liquidity becomes tighter. Yeah,
Yes.
and this is actually the blue line. When the liquidity is tight, then that we get high monetary growth because uh, because treasury buying, yeah, it's safe haven, US assets, safe haven buying, yeah, because when we have a crisis, worldwide money gets into the dollar and also US assets, yeah, so in government bonds, and this liquefies actually the monetary supply in the US. Yeah, US is very fortunate for this. Yeah, safe haven or whatever reserve currency advantage, and also here, yeah, in the 2008, only the crisis brought monetary growth back up again. Yeah, and also in 2020, yeah, the COVID. The COVID crisis brought up the liquidity once again, yeah, and then we got a huge recovery, yeah. This is how it works. But now the dangerous thing is now we got actually again a tightening liquidity, but monetary growth did not go up yet. Yeah.
I see. I
So
see what you're talking about. It's a divergence here based on how it normally is. This is like a massive.
yeah, exactly. So, but we need monetary growth. Yeah, that the recovery can come. So there's no recovery in sight so far. Yeah, and this is why it's so urgent for the Fed to bring down inflation because they want to bring up monetary growth. This is the main purpose, yeah, for this hastily arranged, yeah, huge interest rate increases, because the monetary growth has to increase, and unfortunately, a kind of crisis is needed, yeah, to bring up monetary growth, because then the money will go into government bonds, and actually it happened already in the last 3 days, yeah, interest rates. Treasury yields went down from 4% to 3.5. Yeah, and there's a huge flight to U.S. government bonds, and you can see when we get the harder the crisis gets, the more liquidity is created, and the stronger will be the recovery in 2024. Yeah, but we will get hard times in the next 6 months or six to 12 months. Yeah, that's the point.
Okay.
Yeah.
Fantastic. I love this. Thank you so much for sharing this with us. It was incredibly
Yeah.
valuable to me. I finally understand these charts. I have to say, when I'm just looking at them passing by, I don't really get it. And when I don't know how something can benefit me, I just ignore it, because I'm like, well, that's cute. Well, it's true. But now I finally understand,
Yeah,
what these charts actually mean and how I can use them to sort of, okay, this is what these charts are saying for the next 6 months or so, 3 to 6 months. And then
yeah, exactly.
I can just have another point of reference for my own work. And I love it. Thank you so much, Heinrich.
Yeah, yeah, and we should check in 6 months once again where we stand then. Yeah, we can can see what's how it's confirmed or not. Yeah.
We absolutely should. Oh, this has been such an honor for me to talk to you. Everybody, Heinrich's Twitter handle is going to be in the description here. Definitely please follow him. He's a great follow. He's somebody who doesn't just say what everybody wants to hear. He says what he actually sees in the charts, which is incredible. He's not afraid to take a stand, which is incredible. And he's just awesome person as well. And so, and also I'm Cordova Trades. Also follow Place Your Trades. And I appreciate your time today and have a great rest of the week trading. Okay, bye.
Thanks.